Tom, it seems that every company I speak with feels that it's nearly impossible to get access to bank financing today. If you would, clarify for us, is it the banks truly not willing to lend? Is it the regulators imposing stiffer penalties and restrictions on lending? Or is it merely that with the current economic situation, many companies just aren't as creditworthy as they once were? And then part two of the question, do you believe the repayment of TARP funds or a tax on TARP recipients will continue to have a negative impact on the credit markets? And more broadly, what are your views as to how the administration's taxation or other policies are impacting the credit or other markets, either positively or negatively?
I could just give you a simple yes, Kurt. to those.
Good luck with that.
Yeah, really. This is how long do we have? I think the sort of like the IPO market, the credit market is a two-tiered market right now, anyway. And for larger companies, we've seen the credit open up, and then for define larger maybe companies with EBITDA greater than $40 million. As at least one level, and loosen up in terms of the multiples that the lenders will lend them against EBITDA. Some of the terms, covenant light is actually in PIK terms that I didn't think I'd hear again. I've heard recently. I'm not sure that's good news. Middle market leverage loan volume, to a point Randy made earlier, has gone from essentially nothing first quarter of 2009 to a couple of weeks ago we had the largest volume on a record. And if you add in the high yield volume, they're over a $10 billion issuance week in the public market. So for the larger companies, I think it's getting better out there without a doubt. Now for companies with less than 40 million of EBITDA, I think it's still pretty tough to borrow money, and it goes back to a view that I think we all understand intuitively, and that's that in today's credit markets, large banks lend to large companies, and small banks, regional banks, lend to small companies. And the large banks have been the ones that got the TARP money and all of the benefits, so to speak, from the government's largesse in terms of saving them too big to fail, while at least the small regional and the community banks have continued to suffer. They're the ones that imbibed in all of the real estate investments, both on the residential and on the commercial side. And if you follow the numbers like I do, 4 to 6 banks per week are failing. Well over 100 failed last year. And so I think until we see some improvement in that small community bank, small regional bank market, it's going to be tough to be a small company, even if you're doing well, to borrow money. I just think that they're preserving capital in light of more active regulatory scrutiny. And the follow-up question there occurred as far as the TARP funds having to be paid back and all that. I never really sensed that sort of got in the way of them lending. And now that they've paid back that TARP money, I think that we've continued to see a pickup in the activity. The tax on the TARP institutions remains to be seen. But the numbers that I've heard, 0.15% of assets or something, it's fairly de minimis. And I don't think. I heard one story where the big bulge bracket guys sort of heaved a sigh of relief when they heard that number, that if they could get away with that, they would be pretty happy. But again, I think it comes back to what I said before. People can handle anything but uncertainty, and that's the environment that we live in today. And what companies need now, in my opinion anyway, is not so much a tax credit for hiring someone as they need customers. And customers need confidence, and once you have customers, then you can justify hiring employees and things get back. And until we get away from this us versus them mentality in Washington these days, I think it's going to be hard to try and do too much on that side.
And these are all great comments, and couldn't agree more. The leverage pendulum always swings one way or the other too far. And this time in this cycle, it really swung both ways out of whack. And really, once we get back to a somewhat normalized market, I mean, that's when the ball will start rolling down the hill from a transaction volume. And I'll focus again on the middle market. I mean, again, I think this time last year, literally completely shut down. I mean, no one lending to this market, and we've continued to see new entrants back into the market. Again, a high yield market is out there. You've even, Tom mentioned Covenant Light back. You've seen dividend recaps get done here recently, all that kind of stuff. But once we get back to a true, call it 2.5 senior, another turn of junior capital market in a market that is sustainable, that's when transaction volume will really start to flow. And it's starting to happen now somewhat, because at least at this point, going back to Jim's earlier comments, earnings have picked up, and with the fourth quarter, you finally saw a year-over-year pickup. And so banks now have something they can underwrite to. I mean, you have a real trailing 12 months number that you can underwrite to, and I think that's a critical determinant of getting some of that flow back in.
Well, first of all, if you have a mortal enemy, somebody you really want to pummel, recommend her or him for a bank board. It's the worst thing you could possibly do to a fellow human being. The only comment I'd add to Randy and Tom's, I thought, very on-point commentary, is the possibility that there's another issue kind of looming in the intermediate term that we're not talking enough about, and that's the fact that all of the CLOs that have really funded the leveraged loan market for the last decade are reaching maturities over the next 3 or 4 years. All of their investment periods are going to expire in the next 3 or 4 years, and there isn't any new CLO formation happening right now. And at the same time, you've got a tremendous maturity bubble coming in 3 or 4 years. So you're basically going to create a tremendous supply overhang, and somebody's got to figure out where the demand's going to come from with all those CLOs expiring. And thus far, I haven't heard anybody give a cogent response to that. I mean, I'm waiting for somebody to explain that to me, but like Ricky said to Lucy, someone's got some splaining to do, because that's going to be an issue.
And you've got something called the U.S. government that's going to be competing with you for those
Well,
funds too.
Right, and today, I guess Obama, or maybe it was yesterday, announced $50 billion for community banks at what he said were ultra low rates, which again means they're going to give the community banks a carry trade for a while. So maybe you should put somebody on a backboard. Maybe now's the time.
Yeah, and that's the same as the entire LBO bubble that a lot of the private equity groups are in now, sort of pretend and extend and hope that you'll be able to grow your way out of this problem and be able to refinance your credit at that point. And I agree, it's a big unknown.
Hopefully we'll find a way to make money on it.